Good afternoon. I'm Robert Luft with Luft Financial. It's May the 5th, 2022. The team thought we'd put together a series of questions that our clients are asking now in order to help you weather the storms through some of the current volatility we're seeing in the equity markets. So it's really important to maintain your composure during these periods of stress, and we thought we'd help you this way by just putting this quick video together. With this video, we hope to answer three of the top questions that we're getting from our clients on a regular basis over the past few weeks. Mandatory disclaimers as per normal. What are these top three concerns that we're seeing then? Number one, should I change my strategy? Number two, should I invest more money now? Number three, what's the portfolio management team doing about it? So let's go for number one. Should I change my strategy now? Well, in order to answer this question, we have to be aware of our own personal emotional biases. You generally have to maintain a growth mindset when you're going through this level of market variability. It doesn't make a lot of sense to change your financial plan or your investment policy statement at the bottom or near the bottom of an equity market. Remember, your original time horizon was more than likely over 3 years for the portfolio that you established. And with that, you had set up an investment policy statement that was either meant for income, growth, or a combination of the two. You didn't require 100% of the capital as a lump sum, and you didn't require that capital, all of it, within the next year. So much like a pension plan, it was either invested to provide you long-term growth or to provide you a regular income stream through retirement. That time horizon would generally be over a 3-year period of time. So reacting to short-term market moves and changing your investment strategy in the short term wouldn't make a lot of sense. Now, what generally happens is during these periods of decline, these troughs, as it looks like, the only strategy that you can really implement is to run contra the herd. So as we know, the herd will accept substantial losses and fully exit or keep selling. You need to avoid rash decisions like this. We see these cycles in things like irrational exuberance and overconfidence when certain securities or sectors of the market go parabolically up. We never know when these periods are, but it's generally times when you're hearing all of your friends talk about that asset class. This is usually followed by periods of anxiety if assets start to fall back, denial, panic, capitulation, and agony. Now, we don't know where we are right now in the economic cycle and the market cycle, but we definitely are starting to see signs of capitulation. Now, unfortunately, the agony and depression stages can last for extended periods of time. During COVID, it was very short-lived. During the 2000 to 2003 crisis, it lasted a lot longer. But what you do know is that the sentiment around you will change from one of euphoria and overconfidence to desperation and capitulation. These are quite often the best times to invest. Now, knowing that, the next question we often get, question two, is should I invest more money at this period in time? Well, you'll never know when capitulation exists till it's in the rearview mirror, but what I can tell you is never invest money that you might need all of back within the short term. And we generally try to define that as 3 years. The reason for that is you're investing as per your investment policy statement. That will dictate the amount of equities in your portfolio and the amount of income-oriented securities. So if you have longer-term funds available that you don't need within the next 36 months, and you align them with your investment policy, maybe growth at 80% stocks or balanced growth at 60% stocks or conservative at 40% stocks, what you're really indicating is how long you can keep that money invested and the maximum drawdown you're willing to experience in the short term. So here's a graph of the equity markets in the year 2000, and this is a balanced portfolio. So what I usually explain to people is even with a balanced portfolio, when the markets were down 40%, you had to experience drawdowns of close to 20%, and you had to keep that money invested for the better part of 3 years, almost 4 years, to get your money back to parity. So what I tell people is always invest as if it's the year 2000, because you don't know how long a recession or stagflation or a decline will last, but you have to be willing to ignore your emotional bias and ignore that feeling and that desire like you wanted to sell. So what are we doing about it? Well, one of the things that the PM team does on a daily basis is actively monitor the asset mix of the portfolios. And by that, we mean for every level of risk, be it growth, balanced growth, conservative, we have set targets for each of the various asset classes, and we will regularly set those targets, for example, for US and Canadian stock markets. If they drop to certain targets, we become buyers. If they rise above our certain targets, we become sellers. And this is that active rebalancing of your portfolios that we do. We'll look at the entire portfolio, the entire over $500 million that we manage, to ensure that we're at our asset allocation targets at the asset mix and at your client portfolio level. And our software that we utilize for rebalancing will tell us that on a daily basis. So the areas of the portfolio that might be outside of our targets are bought or sold to keep you on track with your investment policy. So it's never fun to go through periods like we're experiencing right now. One of the things you have to realize is that we are active. It generally makes more sense to add money if you have a long-term bias. You'll never get the bottom. But please do reach out to your portfolio management team and your advisor. Ask us questions, send us emails, phone the office. We're here to help. And hopefully this will give you a little bit of reprieve as we head into what could potentially be a very volatile summer. We will continue to actively manage the portfolios for you, and we're here to help if you need it. Thank you, and talk to you soon.